Hello everybody. So this video is about health stocks. When cheap gets cheaper, what do you do? Because I've been getting comments about these stocks and they got cheaper. Delcath, of course, went down. BioStem went down rather sharply the other day, down 11%. And CorMedix went down after they announced a new capital raise that was poorly timed. But when you zoom out, first of all, I want to point out 1 year, up 41%. Up 3%, but keep in mind we had that abnormal news that took the dropped the stock like 2 days ago. So you're probably up more like 10 to 15%. BioStem. So BioStem hasn't done too well, but they have some good stuff coming up. And then the last one is CorMedix. Past year is plus 122%. So plus 41, plus 122, plus 3. Zooming out already helps out and already invalidates the comment of saying, oh, stocks are down. Oh, what's happening? It's the end of the world. Point number 2, there is something called basket selling. And, of course, these stocks are more volatile because they're smaller. All of these stocks are less than $1 billion in market cap. And so they're going to drop more than the sector in which they are. But if you look at the S&P 500 healthcare sector, so that segment of the S&P, it's one of the lowest performing sectors in the S&P right now. It's been down. The reason why it's down is because of, in my view, basket selling. It's often seen as a riskier part of the market. And right now it may be down too because a lot of people don't want to get exposure to healthcare because they want to wait on the tariff news. The healthcare hasn't been impacted by tariff. My guess is that a lot of the market is kind of like, okay, we got to wait until we get that tariff news. That may explain why the sector is down. But in general, when you invest in this type of stock, which have FDA registered or FDA approved product, right? In the case of Delcath and CorMedix, wound care is regulated differently. But anyways, the point is, when you invest in this type of stock, you have to realize that they're riskier. Why are they riskier? Well, they're riskier because you have more single points of failure in the thesis. And the classic, and of course people call them biotechs, and they kind of group them together in biotech. And even if you're not a biotech, they're still going to call you a biotech. But the whole idea, you do phase 1, phase 2, and then phase 3, for some reason, there's a problem, and then the thesis goes down, and the stock goes down 50% because you didn't have the right data and you didn't get your FDA approval. So you have a lot of single points of failure in the thesis. Single events can hurt the thesis. And more importantly, you can have a bureaucrat, a new administration, a rule change, a bad data point, whatever, can ruin the thesis. That's why they're cheaper, and that's why they're riskier, because a simple rule change can ruin the thesis. If you look at Semler Scientific, for example, which is a stock I covered before on the channel, that's exactly what happened to them. They were a wonderful medical device, and then all of a sudden, they lost coverage. And when you lost coverage, the stock was heading towards, way down, perhaps towards bankruptcy, and everybody stopped ordering the stock, and they pivoted to Bitcoin to save the company. This is inherent to the risk of investing in these companies who have single points of failure, but in exchange for that risk, what do you get? You get a very, very, very cheap stock. I mean, we are talking about 3 stocks that are each cheaper than HIMSS. We are talking about BioStem, which is the cheapest in the history of the channel, and then Delcath and CorMedix, they're top 5 cheapest in the history of the channel. That's what you get in exchange for the binary risk that some of these companies have. So that's what I call asymmetric upside. So let's talk about Delcath. Delcath, as a reminder of the chart, it's down. It's down a little bit from the past month. It's only up 41% in 1 year. So what's going on with Delcath? Well, nothing really. There's nothing going on. We're waiting for Q2. That's what's going on. We're waiting for Q2. So maybe the market may be fearful about CMS or Medicaid negotiation because they entered a Medicaid rebate program. So maybe there's something going on with the Center for Medicare and Medicaid Services, CMMS. Maybe, but I don't even know because that rebate program is just making the product cheaper. That's not necessarily going to be a big deal. I'm not too concerned. Some say R&D is going to be a little high, and so that's going to hurt profits. But then again, I'm in this stock for the growth. The profits come later. As far as I'm concerned, I want to be here for the growth here, part of the product, and the adoption of this product is doing very well. They're investing in R&D. Yes, I want them to invest in R&D because you can see their catheter. So if you remember what Delcath is, that's a catheter product that allows you to deliver hyper-targeted chemotherapy solutions to single organs or single areas of the body by having two catheters, and it's a platform, right? And you can deliver the chemo dose. You can target it much better with that system. So that's why they say Delcath, concentrate on what matters. And of course, they're approved for liver cancer, which is a difficult and rare, but a difficult to treat cancer, and that's why they got approval for that, because the FDA oftentimes will take into account if there's solutions that already exist, and they don't want to approve too many solutions that already exist, even though it would be good for everybody if they did, but they don't. So they got approved for that, but they're a platform. That catheter system is a platform, and it could be used for. They are trying to get it approved for metastatic colorectal cancer, so another unfortunately common cancer, and metastatic breast cancer. So that would obviously be a big deal if they got that approved there. And they're enrolling patients, and it takes a while. And yeah, they have to invest money in R&D if they want to be more than just a single treatment company, and maybe if you want to own this company for a few years, maybe you're going to have something that treats 2 cancers or 3 cancers. So their R&D, maybe it's down because people are concerned about their R&D, but as far as I'm concerned, I wanted them to expand their platform and their products, so I'm fine with that. I consider R&D in future products to be an investment by the management team on my behalf, and some say 800 patient total addressable market is not enough. To which I disagree entirely. I think if they just get half of that, that would be huge, because this treatment, and it's an early treatment, so it's $768,000 for this treatment. Keep in mind, this is a rare disease. This is complicated stuff. But if they get 800 of them, that's $614 million. That's more than a 10x in revenue that you may be looking at. Even assuming that they get half of that, that's still a good 5x in revenue. So to me, I see enormous growth runway, both in the current addressable market size for liver cancer, and then for breast and colorectal cancer, that should explode the demand if they ever were to get approval on that stuff. So I'm not worried. I think the stock is very cheap. When I look at the numbers, EBITDA margin is on the way up. It's going to go up more, although that's what people complain about over R&D spend. Gross margin is very high at 86%. So even then, 86% gross margin, that tells you that it's still not a cheap treatment, right? I mean, this is still something that costs them, $80,000-$70,000 to produce. Like, it's not a cheap treatment by any means, and these margins are not out of line in that sector. 86% is not out of line in that sector. This is a company that developed it for a long time. So, anyways, and forward revenue growth is 120%. So, when I look at the numbers, it's trading at 3 times forward gross profit. It's trading at a little under 3 times forward revenue. And it's so cheap at a 0.06. So I'm happy to own it. So long-term hold. This is the type of stock that I would judge after years, not after, what is it, a month? Was it a month? Yeah, a month and a half that people are complaining. No, I would judge this after like a few years. That's when you judge these type of companies, at least in my view. Point number 2 is BioStem. So BioStem, let's talk about BioStem. BioStem is my high-risk, high-reward stock. BioStem is the cheapest stock in the history of the channel. There has never been a stock cheaper than BioStem in the history of the channel. This stock is currently doing $333 million in revenue, and the enterprise value is $150 million. So it's trading for half sales. It's trading for 1/4 of forward sales. So the price to future sales on this company is a 0.25. I live in a world where if I see a 2 or 3, I'm excited. This is 10 times cheaper than the stock that I usually find attractive, right? It's trading at enterprise value over trailing 12-month EBITDA of a 4.5. It's over future gross profit 0.26. I mean, this is nuts. Cost of goods sold on this product near zero because it's placentas. It's a wound care dressing. That's what they call it. I call it a bandage made out of placentas. The gross margin is 96% because they get the placentas for free and turn them into wound dressing for wound care. And so this stock dropped 11% the other day. Why did it? And keep in mind, it's a 10x in 5 years. It's 10x in 5 years. So first of all, that needs to be said. But if you focus on the past 5 days, yeah, it's dropped 11% in the past 5 days because of, frankly, something that was already known. This was the news that spooked a lot. A lot of stocks were spooked by this CMS announcement. Not just BioStem. A lot of stocks were spooked. So CMS proposes physician payment rule to significantly cut spending, waste, enhance quality measures, and improve chronic disease management. And so part of that memo, that document, that period for comment that they have, where they ask for commentary, wound care was addressed because some people are being a little too liberal with the charging, and some people have abused the system, or at least that's what they say, right? They've abused the system. So the goal of CMS is to cut costs, cut waste at all times. That's what they call waste, right? It's what they call waste. Always, like I said, always go back to the example of Semler Scientific. Semler Scientific had a machine that was very successful, that physician loves and everybody, and CMS said we can't use this machine anymore. We have to revert back to a technique from the 1950s that assistants are going to make, because that technique is free. While anyways, they didn't have a choice. So sometimes they will go above and beyond to cut something that actually has some benefit. It's the polar opposite of capitalism. It's unfortunately not the patient that chooses. It's a government organization that chooses who gets covered or not. So, is BioStem going to be in the local coverage determination in the LCD in 2026? On January 1st, 2026, are they still eligible for CMS reimbursement for Medicare? Are they still eligible for Medicare? We still don't know. This doesn't change the thesis. We still don't know, and we should find this out sometime in October or in November, whether they're still covered or not. So maybe this reminded the market that we still don't know if they're losing reimbursement or not in 26, but we still don't know. So this is not new information, and so I don't understand why the stock reacts to that. The point that I've made before is that, there's more than just Medicare that pays for these things. Okay, a lot of commercial insurance companies follow whatever Medicare says and match their plans to Medicare's plans. But that's not always the case. Sometimes you can override that, and sometimes you will have different plans with different things. And so it's up to BioStem to negotiate with XYZ Insurance. And then you always have the issue or the advantage of cash pay. There's always going to be a market for people who want to be cash pay. So granted, maybe it's a smaller business, but given the fact that this business is entirely pricing in everything going away. Like if I look at this, I mean the company is 150 million, and there's 6 months to go of reimbursement, and they're likely going to get 150 million in revenue, if not more, because it's growing. So how many millions in revenue at a 96% gross margin are they going to get for the next 5 months? Yeah, 5 months now, 5 months and a half until the end of the year. How many? Is it going to be 200 million at 96% gross margin? So this company is going to be stacking cash very, very hard. And then I don't know what they need to do. Maybe hire a better sales team, go negotiate with a commercial payers, lobby Congress people, make comments on Medicare, do more research, publish more research, right? So there's a lot of things they can do with that money. That's point number one. And then we don't know if BioStem will make the cut or not make the cut. Frankly, I find their product very innovative. I think using placentas is at the cutting edge of what we do, and you know, that's valuable in and out of itself. I think this company could have a lot of value also in the way of stem cells, because if they have a good placenta collection system, they could do something with stem cells. So that's another thesis that I have for this company. They could do something in the Muslim world, because you may know that a lot of these wound dressings are made out of pig skins, but they don't call them pig skins. They call them xenografts, because xenograft sounds fancier, and you may hope that your patient doesn't know what a xenograft is, and so maybe they can have a campaign. You know, I don't know, but I guess they would have to go international. But it's something you can do. This is amniotic tissue, so this is really cool if you ask me. And the bigger catalyst for them, in my view, and this again, they are held hostage, and quote unquote, from the SEC, which move at a snail speed, at a snail's pace. They are waiting for the SEC to make a determination on how they should recognize the revenue in the books, from what I understand, and there's an issue with the suppliers. And the SEC is so slow. It's taking its own sweet time. And this is the only thing, is a clarification from the SEC. That's the only thing that they need to be uplisted to the NASDAQ. And once they get uplisted to the NASDAQ, then what happens is then you can have anybody buy, right? If you're uplisted to the NASDAQ, they become available on Robinhood, for example. They become available in many, many more places. They are not just an OTC stock anymore. Part of the reason why this stock is so cheap too is because they are OTC, of course, and a lot of people don't want to buy OTC stocks for XYZ reason. Makes it harder to make it to the indices, etc., etc., etc. So, BioStem, it's risky. It could go to zero, but look at that valuation. Look at that valuation. So, what if they are remaining in the LCD on January 1, 2026? And what if they get an uplisting to the NASDAQ? That's, you know, that in my view, if that happens, we're going to get a multi-bagger on this one. In my view, if that happens. If that doesn't happen, it goes to zero. What are the odds? And perhaps not, by the way. Perhaps it doesn't even go to zero, because the cash on the balance sheet is always going to have value. So, you know, to me, this is an asymmetric bet. Like if you're looking at a 5 to 10x, and you're looking at a full loss versus 5 to 10x, and you do some expected value, and you're like, okay, well, there's about a 70% chance they don't get the LCD, they don't get the uplisting, and there's a 30% chance they get it. And you place those odds on a 10x on one side and then losing everything on the other side. Well, you have a positive expected value on this stock. This is asymmetric. Bet. This is an asymmetric bet, in my view. That's the way I look at it. That's why I own it. That's why I like BioStem. It's just me, right? No financial advice ever on this channel, as you know. The last company, and this company, CorMedix, this company, in my view, they've dropped. The stock has dropped because of, I'm gonna use the term, weird timing, or the management did something weird with the common stock offering. And I'm going to use the term weird because I don't know if they're trying to acquire another company. That would be a rational explanation as to why they're raising $85 million plus an option for an extra 15%. So let's assume they're raising $100 million. They're trying to raise $100 million right now. And they have $78 million on the balance sheet. And the company is firing on all cylinders. The EBITDA margin is 52%. So that's proxy for cash flow. 52% proxy for cash flow. Growing at 180% growth rate. The stock, if you follow this stock, you may know they talked about how the second large US LDO organization started ramping the product at 50% to begin with. So they're going to have to supply that second largest LDO organization. When they announced that, the stock popped. It popped quite a bit, something like $17 or something. And then they did this share offering 3 days later. And then the stock drops 30% because they did this share offering 3 days later. So normally you would do the share offering. Normally you would have the share offering in place before you make the announcement that everything's doing well and your sales are going to ramp up, right? Because you want to sell into strength. To me, the only reason why they didn't do that is because they didn't know. They probably didn't know they were going to do the announcement. So maybe at least I hope. So maybe an opportunity came up, right? Or there could be a fiduciary reason or a legal reason. Their legal counsel might have said, sorry, I know you want to do a common stock, but you really have some meaningful information here with that customer. Timing sucks. It's unfortunate that customer decided to let us know that they want to ramp right now, but you need to let your shareholders know because this is meaningful information that you need to disclose right away per the SEC. And so it was bad timing for them, but they had to do it because they had to follow the book. Their legal counsel might have said. So maybe this is something like that. I don't know why they did this timing. The timing, it would have been much better to do the public offering. You have the offering in place, you spook the market, and then after the offering is there, you release the information that you're ramping your sales and your sales are accelerating at that second large US LDO. And so I look at this stock as the initial reaction that took the stock to $17. That was the right reaction in my view. That was the right reaction. This business, CorMedix, is a simple business. They do these vials. People, at the end of diabetes, there is dialysis. If you don't get it under control, if nothing else works, you have to go to dialysis. 2 to 3 times a week, you have to go to dialysis. You have to get your kidney flushed, I guess is the way I'm going to say it. When you go to dialysis, you have 2 tubes coming out of your torso. These tubes are exposed, and you could get an infection and you could die. So what CorMedix does is it's a solution lock. It's a fluid. They sell these vials, and you drop the fluid in the tube, and that fluid reduces infections by something crazy. I can't remember the numbers. It's like a there you go, 70% reduction, something like that. Well, I guess that's the anyways. It's great. It's a great product, and it's not that expensive of a product in the grand scheme of things. And it's definitely less expensive than an hospitalization for someone with a bloodstream-related infection. So that's why the CMS is paying. Right now, it's about $250 a vial. I don't know how much they're going to pay in the future. Probably less than that, but they're still paying. Fresnicius and Davida, which are the 2 large LDO, there's 2 very clear customers. These 2 customers are ramping up the product, although I'm guessing here. I'm not saying they definitely are. I'm guessing they are. This is allegedly, right? I'm guessing, and I'm guessing that one of them is the second large LDO organization, right? It's pretty obvious. So there's 2 of them. They're ramping. These big organizations, these big dialysis centers, they have an incentive to adopt the product because they are getting more money the less infections they have in their patients. And so product is cheap. Product saves money for Medicare. Customer has an incentive to adopt the product. Product is very sound. It makes a lot of sense. If you use a little vial with not a lot of side effects, you can avoid infection. So I like it very much. The big question mark is, why are they doing this common stock offering? Are they envisioning a adoption of the product so large that they need to build a new facility that they can't build with $78 million worth of cash? Is that what's going on? Or are they trying to do an acquisition? Are they trying to do I don't know. I don't know. I really don't know. So this is one of the stocks where we'll know much more on the call, and people will ask on the call why we're doing this. So and if you know, let me know in the comment section. So anyways, this was not investment advice. This is not financial advice. This is only entertainment. I'm hoping you are entertained, and entertained only. I'm an entertainer. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.